times are good. You guys have always paid your dividends and have generally increased them. How have you managed to do that?
Well, Teekay has a different business model. Rather than rely upon the spot rates, we've been constructing all of these fixed rate cash flows, which today are over $600 million. And so Teekay Corporation went public in 1995, has always raised the dividend, and even when times were tough, we've maintained the dividend. And now we've constructed 3 daughter companies, and just the distributions we get from our 2 MLPs is enough to pay the dividend at Teekay parent company.
So you've got an LNG, liquefied natural gas MLP, and you've got an offshore one that, what do they do?
Yeah, Teekay LNG Partners operates LNG carriers, which are on 10 to 25-year contracts, and Teekay LNG Partners pays a dividend or a distribution, since it's an MLP, of about 7%. Teekay Offshore Partners is in the offshore sector. They have contracts of 3 to 10 years with oil majors operating mostly in the North Sea as well as in Brazil. Brazil is one of our biggest markets, and that distribution is closer to 8%. And in each case, Teekay LNG Partners went public in 2005, and we've tried to raise the dividend every year as we add projects. Same is true with Teekay Offshore. We raise the distribution as we add projects. So this year, for Teekay LNG Partners, we've added 2 gas carriers, and in Teekay Offshore, we just announced this week that we've bought a floating production unit. These are one of these deep water floating production. And we're going to buy 3 shuttle tankers, which takes the oil from offshore production units.
You know, a few years ago when commodities, oil, and everything else was booming, all the dry bulks and all the tanker companies were booming alongside with it. How much would your stock price, move if oil moved a lot? Are you guys really dependent on that? It seems like you are.
Our customers clearly are dependent upon the movement of oil. So when the oil price goes up, it usually means there's a demand for oil. But actually, oil, which we burn as fuel, as bunkers, that's paid for by our charterers. So the price of oil doesn't cut our profit margins per se. But obviously, when the price of oil goes up, there's more oil being demanded, and that's good generally for tanker rates.
What's driving demand in the shipping, in the energy shipping business right now?
Well, what's really happening is that China is continuing to increase its import of oil, and the U.S. had lost the amount of oil that they had imported because we weren't driving as many miles. That's now bottomed and is coming back. So you could say that Europe and the U.S., we lost about 4 million barrels of oil, but that's now being recouped. So oil demand is very positive as it relates to tanker demand right now.
And your customers don't say, hey, sorry, we got other plans. If oil prices go down, they might cancel projects and scoot out?
We haven't found that. In fact, what we're finding is the oil companies being cut off from a lot of the areas that national oil companies are doing. They're accelerating their developments of LNG and deep water offshore, which is where our 2 MLPs were.